Pleased to say I've been joined by Michael Haney, who is Head of Product Strategy and Outbound Product Management at Galileo Financial Technologies. Michael, how are you?
I'm doing well, thanks. Dealing with the hectic conference, but it's a pleasure to be here and speak with you.
Yeah, it's good to see you, yeah. So, answer me this to start with. How is the fintech industry evolving regarding client segments the digital challenges are focused on? So, regulatory, compliance, and partner banking specifically.
Yeah, absolutely.
It's a long question, but yeah.
it's a rapidly evolving space
Sure.
with these digital challengers. Sometimes we call them neobanks or fintechs.
Yep.
They, especially here in the US market, a lot of them started off with a similar journey, looking for those underserved or unbanked segments and trying to get a better value proposition for them, often in a mobile-first environment. And they often started looking for those affinity groups or those niches, launching a debit card and related transaction account. But many of them obviously didn't survive, and the ones that have survived have thrived. I think the trick is diversify or die, right? You have to continuously evolve. Your client base does not stay stagnant. Their needs change as you go through the life cycle with them. So your products and the number of different customer segments and geographies that you go after should expand accordingly. Mm-hmm. Otherwise, you risk losing them. Mm-hmm. Let's say that your initial product was in that sort of credit builder space, trying to help you get better credit scores so you have more access to lending. Well, if you succeeded and you don't have products for them now that they're prime customers instead of subprime customers, as an example, they'll go elsewhere and look for their financial services. On your second point there, the regulatory compliance, so we can all see what's coming. It'll probably be in the shorter term that there'll be greater pressure on the partner banks or sponsor banks, as we call them, mm-hmm. To hold their both their processors as well as their fintech clients more accountable and ensuring that they're adhering to the bank's policies. And someday we might even see the fintechs regulated more directly. Some countries we're already seeing, the possibility of a fintech license being granted, which might be separate from a traditional banking charter. But we should see that regulatory space evolve quite rapidly as well.
And talk to me a little bit about the incumbent banks then. Obviously they need to modernize their legacy infrastructure. How do they go about doing that?
Yes, so they're feeling the pressure, right? The fintechs didn't have the issue of legacy infrastructure, legacy processes, and more importantly, legacy mindset and culture. So they had that advantage of starting greenfield, and I would argue that traditional incumbent banks can start greenfield as well. Sometimes we nickname that as a digital sidecar, so looking for ways to reach customers outside of your branch network, mm-hmm. perhaps with a new brand or going after segments of customers you didn't traditionally go after, launching digital-first type of products. Sometimes we see them entering new geographies in a digital-only way. The big example out there, of course, from the US is JP Morgan Chase launching in the UK with a direct or digital-only bank. Or perhaps a new product line like buy now, pay later as a new offering that you don't have to build on your traditional tech stack, your legacy tech stack, but in fact build it on the side with new. So greenfield is a great way to get comfortable with the new technology and the new business models while also generating a bit of revenue. And then once you get comfortable with that, you can come back to the so-called mothership and start incrementally and progressively eating away at your legacy tech stack. Yeah. So big banks can learn a lot from the challengers.
Okay. Now, we couldn't really not have a conversation about AI at Money 2020, could we?
Yes.
So, how is Galileo embracing that trend?
I would point to three areas. Two of them are quite specific to the solution that we offer. We do have a virtual assistant, sometimes nicknamed as a chatbot, which started out, like many of them, with traditional AI technologies like natural language processing, and we're looking for those ways to incorporate the new darling on the block, of course, which is Gen AI. And we're doing it first and foremost with just improving the product and the bank staff experience before rolling it out to directly interact with customers. A second product line is our fraud, in our areas of fraud. increasingly adapting those machine learning models to help improve detection with fraud and prevention of fraud types of technologies. And then, of course, we are interjecting it into our data and insights layer. So moving beyond just providing that raw data to our ecosystem partners and our clients, and being able to provide more advanced insights and analytics that they can enjoy. So those are the three primary areas that we're starting to see AI permeate into the Galileo ecosystem.
Yeah, it'll be really interesting to see how that space accelerates.
Yes.
If we have this conversation, this time next year, I don't know how much further down the road we're going to be. So yeah, that's really interesting. Okay, let's just move the conversation onwards a little bit to real-time payment networks. The USA now has 2.
Yes.
What do you see as the way forward now?
We were a little late to the game compared to some of the other markets. Obviously, we look to countries like India, Brazil, UK, as they adopted faster payments and see what we can learn there. But yes, we finally have both FedNow and RTP rolled out, and we're seeing every day an increasing number of banks attaching themselves to these new rails. What's obviously the most interesting is the use cases. So we're going to start to see, particularly I think in the B2B space as well as the B2C space, some interesting use cases come out. We already starting to see, let's say the gig economy is a popular one that we like to point to. So the Uber drivers, the Lyft drivers, the DoorDash, they want to get paid per each task rather than waiting 2 weeks or 1 month in a sort of traditional paycheck model. And so, that brings up the whole concept of pay by bank as well. So that we as consumers as well can start to enjoy this to sort of bypass some of the card networks. So I think it's going to be a rapidly evolving space. I think it has the potential to completely disrupt and maybe in the long-term future disrupt and eliminate the card industry. So we're all kind of excited of what this space can bring us. But it's always important, especially in the consumer world, to remember that changes in behavior are the thing that takes the longest. It's not just about technology adoption. So it'll be an exciting future.
Two-pronged strategy, absolutely,
yes.
Yeah. Let's finish up the conversation talking about payment fraud, if you don't mind. So I'd be really interested to hear about your thoughts about how Galileo helps businesses, banks, fintechs prevent and then detect fraud in the first place, I guess, as well.
Yes, fraud always comes down to those three legs of the stool, if you will: prevention, detection, and then recovery. Yeah. We actually began life with the dynamic fraud detection for our own debit card processing solution, and we've now opened it up so that you don't even need to use our debit card processing solution to detect that. We've evolved it beyond cards as well, so you can use it for ACH and wires, a so-called account-to-account or non-card type of money movement. And we are, as I mentioned before, injecting newer types of technologies such as machine learning and link analysis and those types of things to improve what we can do. And we're supplementing it, that first leg of the stool, that prevention, right? We recently launched what we call the Galileo Identity Verification Engine, which is particularly helpful, let's say, in the ACH world. I think we can all remember a time when you sort of verified your account by getting those microtransactions, like the 1 penny or 2 penny, and then you had to read back. And those often went over the ACH rails and could take anywhere up to 3 days before we'd even see them, and then we'd have to go back and verify. Now we're using open banking protocols, and we can do this sort of instantaneously, especially the younger generation. They're not going to wait for you to verify account ownership and account balance and account status. They want that instantaneous feel, and so these types of newer identity verification services can help bring that to life. We check who's the true owner of an account. Is the account in some way compromised or blocked or frozen in any way? And that helps us not only prove that you are indeed the owner of the account, but the account's in good standing and we can move forward. And of course, we're excited to see where open banking takes us next.
Yeah, we could go into that as well, but I think we may have run out of time there.
Okay, great.
Michael Haney, I really appreciate your time. Thank
you so much for having me. It's great to speak with you.